Welcome back to Why Commodities. Hola, I'm Joe Pardavila, and as always, I'm joined by James Cordier. James, how are you, sir?
Doing well, Joe. Nice to see you, and nice to be on again.
Yeah, it's been a while since we've had an episode. So, from popular demand, folks who have been watching the show on YouTube, listening to podcasts, they really want us to get into the nitty gritty, and that's what we're going to do today, James. So, I think before we start recording, there's no one in a cow suit here today, right?
Correct. Just you and I.
Excellent. So let's get into it. So one of the most highly sought after forms of investing has become options and the alpha that can be known to deliver. Now, it seems new volume records are surpassed year after year. However, you've discovered options trading years ago, and we've talked about it in past episodes. This is not your first options rodeo. Can you tell us what got you started in this form of investing?
Joe, we spent decades analyzing raw commodity data. Commodities that everyone is quite familiar with, nothing too exotic like cobalt or uranium, but just the basic fundamentals of raw commodities, gold and silver and copper, coffee, cocoa, sugar, crude oil, natural gas. We spent years analyzing these fundamentals and what they mean to the commodity prices as reports come out. And this invaluable information is stored, and we have that. And the idea of investing in these raw commodities, as opposed to perhaps stocks or real estate or bonds, is certainly an alternative type of investment. But as much knowledge as we gained over these couple of decades of following these markets, we still didn't have the delivery system. We still didn't have the vehicle to create alpha with all this information until we discovered option trading.
Wow. And out of curiosity, because I know this is the world you live in, but the people that are outside your world, like you mentioned, like real estate, stocks, bonds, how familiar were they in this world? Is it almost like we were talking about like New York, LA? It's like two different kind of worlds, or is there some sort of crossover between those worlds?
Generally speaking, Joe, as commodity prices are making the Wall Street Journal, coffee prices hit all-time highs, gold prices hitting all-time highs. Now, all of a sudden, there's a synergy between people that are in real estate and stocks. They want to get in on that. FOMO starts taking place, and all of a sudden, people are calling their stockbroker, how do I get in on gold? I heard that coffee is at all-time highs, and I heard that there's a drought in Brazil. How do I get in on that? And that's what really bridges the gap right now with what used to be just primarily stock traders or real estate investors. And now a lot of people are delving into commodities. And one of the best ways in order to do that, in our opinion, is through structured leveraged options. And that's what we trade. That's what we sell.
I don't know if you could share this, but do you have any like Pretty Women stories like the Julia Roberts movie? You know, when she goes into the shop and they ignore her. And then when she goes back as a rich person, she goes, big mistake, big mistake. Did you ever have any of those interactions with like stockbrokers decades ago? And then all of a sudden, like, hey, James, I'm not sure if you remember when we talked a while back about commodities. And I was wondering, do you think that was a good time for me?
Joe, unfortunately, my wife, Krista, has made me watch that movie several times. So I actually know what you're talking about. And yes, I had that experience so many times. We were the ones walking into the expensive, store on Rodeo Drive, and we were the commodity traders and the commodity brokers, and people trading IBM and Exxon looking down their nose at us. And that has certainly changed a great deal over the last 5 or 10 years. Now people are seeking us out for what we know about these commodities and this different market that they know very little about. And we're now the Julia Roberts walking into the hotel with all the purses and bags.
Love that. Well done, Krista. She did a nice job showing you the right films in the filmography there. So you've been known for years as a thought leader in options strategies. So we're going to dive straight into what you're doing right now. We talked about the world you came from where it was like completely separated. Now more and more people want to get involved in commodities. So for someone listening or watching who may not be familiar with it, How would you describe your current option selling strategy as opposed to how you may have approached it years ago when you were that young kid in Wisconsin with collecting those silver dollars? I know you weren't trading commodities then, but tell me how much has changed during the course of your career.
Joe, when we first discovered options, we kind of stumbled into option selling. My colleagues and I, taking all of our knowledge about all the different commodities, and how we would approach the market is we would buy options. If we thought the price of a commodity was going to go up, we'd buy a call. If we thought the price of a commodity was going to fall, we would buy a put. And with all of our knowledge, with all of our expertise on following these same 12 commodities for decades, our timing would be pretty good. We picked the direction fairly well. And yet the options that we purchased would expire worthless practically every time. And I'm thinking to myself, we know all about these commodities. We know more about coffee than Juan Valdez. We're really good at this. Why are these options that we're buying not paying off? And then it just dawned on me that you don't buy options, you sell them. And as soon as that light bulb went off, we started delivering alpha. I dug a little bit more into selling options, leveraged options specifically on commodities. And I learned that we had some really good company, the likes of Icahn, huge option seller. Warren Buffett, huge option seller, probably the largest in history. Jim Rogers, the king of commodities, sells options. And right then, I knew that we were in very good company. What we do differently now, and what we still had to learn, is certainly you're selling options. You want to be the house. You want to be the insurance company. But what we didn't know is exactly how to structure these option sales. My colleague and I, we've written a few books on option selling. In that, we list several different tools in which to sell options. And we have really settled into just one or two, as opposed to the half a dozen that we listed in our book. What we do now is structured, leveraged option selling, so that we are taking advantage of the vast majority of the time that options expire worthless, but we have a structure so that we have a limited downside and we have a hedge downside on practically every time we enter the market. And that's the big difference from what we're doing today as opposed to several years ago.
Do you think commodities has a bad publicist? And I say that because, you mentioned that Warren Buffett and Carl Icahn are major players in the commodity space, but you never hear about that unless you're in the weeds of commodities like you are, James. You hear about Warren Buffett talking about this amazing stock, or he's investing, there's headlines when he decides to buy into a company. Why do you think when these are not nobodies, obviously, why do you think it commodities doesn't get that much attention when you're hearing from like the greats of the greats?
The greats of the greats and the biggest of the big boys sell options, whether it's on securities or whether it's on real estate or whether it's in commodities. The numbers they don't lie. The vast majority of options that are purchased far out of the money, otherwise known as deep out of the money, they expire worthless practically every time. And the Warren Buffetts of the world and the Carl Icahns, they get to choose exactly which options they want to sell. Unlike an insurance company, when someone walks into your office, you're basically selling them a premium for an option policy that you may or may not want to write. But as an option seller, you get to choose exactly the details, the exact commodity, and how far out of the money and how much time to sell. These guys have perfected that. I think it's safe to say that Warren Buffett likely didn't make all of that money just buying Coca-Cola.
Right.
He's an option seller and he's done extremely well.
Oh, that's great. That's great. Thanks for sharing that. All right. So you've mentioned, you've literally written the book on this about presenting leverage options as selling as a diversification tool for high net worth investors. So do you still see it primarily as a diversifier, or has the role shifted in now modern portfolios where it's not just something, hey, I'm going to throw this in just to diversify a little bit, or is it now becoming more of a pillar in everyone's portfolio?
Joe, that's a really interesting subject. Often, when the stock market is going up, investors don't want to be diversified. They want to own Nvidia and all the popular stocks, and they're going up 30 and 40%. Diversifying is very popular when the stock market is stagnant or when the stock market is falling. Diversification is just, oh yeah, I need to be diversified. But when the stock market's going up, it's like, yuck, yuck, I'm going to stick with these 8 stocks. Option selling and leveraged option selling, the structures that we create for our clients, can prosper quite well in bull markets, in bear markets, or when the market's not moving at all. And that is the way that people are diversifying. And it is true diversification based on the fact that when I'm buying an asset and it's got to go up in value, well, currently in 2025, it bottomed in April and it's been going up since then. But for the most part, you're going to see over a 10-year period, stocks are down about 3 or 4 years. They're sideways for 1 or 2 years, and they're up for 4 or 5. Generally speaking, that market is a bit of a roller coaster. Anyone who was in some of the high flyers this past April found out that the market doesn't always go up. And I think diversification after 2025 is going to be more popular, even with the mainstream. And if they find option selling on commodities, I think they'll learn that they can get alpha that way.
Wow. It's funny what you mentioned the stock market and it's sort of roller coaster. It almost feels like, now again, this is not as coming from an expert point of view, but like the stock market seems very top heavy nowadays. You mentioned, companies like Nvidia. It almost seems like the entire market is being driven by 10 to 12 companies nowadays. And so in a way, if you want to try to hedge that, being involved in commodities is sort of like an antidote to that, for lack of a better word, because of the fact that that top market, the top of it is just so heavy and it's basically carrying the rest of the market.
Joe, it's so interesting that, we get a lot of inquiries when the stock market's down, just the opposite of what should be, happening with high net worth investors. You should be, diversifying when the stock market is up. I mean, we're at all-time record highs. I don't know how many times in 2025 we're near the high again. Buying low and selling high is very difficult. You need to be buying stocks when everyone's panicking, and you need to be selling stocks when everyone's saying, wow, this is the best golden age we've ever had. Diversification and trading is very difficult for the most part. And that is one of the reasons why structured option selling, for those of us who do that, it takes a lot of the guesswork out of it. It's thought that by the CME and places like this, that's the Chicago Mercantile Exchange, that options that are purchased deep out of the money expire some 80 or 90% of the time. That is a really better side to be on. If you're bullish, sell puts. If you're bearish, sell calls. If you're neutral, sell a strangle on both sides. And that is the trading model that a lot of people are getting to know recently, especially with the explosion in volume trading options right now.
Cool. And so for a stock option seller just getting his feet wet with leveraged future options, what are the key factors he or she should evaluate before selling a spread?
When selling a spread, which is what you should be doing, at least in my opinion, just do your homework. You don't need to become an expert at 14 different commodities, but pick one that you're somewhat familiar with. Everyone follows the price of crude oil recently, gasoline. Gold is in the news currently because, it's making all-time record highs as interest rate cuts start developing here in the United States. That's an easy one. Just do your homework. Find out what strike prices you feel that market cannot reach. And what I always advise stock option sellers when they come into this arena is to always exchange time for price. When you are selling options in commodities, you can often sell long-term fundamental analysis that you've created. This analysis and the fundamentals won't change necessarily in 3 or 4 months. So don't sell a 3-month option, sell a 6-month option. You get paid more, you get to sell further out of the money. And what stock option sellers are going to learn is that you can do it with very little cost and percentages out of the money that you never dreamed of. Some of our favorite clients that used to sell stock options would tell me that they're selling options 3 and 4 and 5% out of the money.
Wow.
And using leveraged options as we do, we sell options 50 and 60 and 70% out of the money. So my advice would be exchange time for price, allow the option to live a little bit longer, and give you the ability to sell much further out of the money. Stock option sellers are always amazed to find out what's available.
Cool. And in past episodes, we've talked about the seasonality. I mean, we did a whole episode about coffee. Who'd have thought you could do that, James? Well, we did. We did a coffee episode. But you write about in your book, Reflections of an Option Seller, about this seasonality in commodities as a key advantage over stock trading. Like price forecasting is something we talked about based on events such as soybean harvest or summer driving season for crude oil as an effective approach in today's age of AI price and forecasting. So tell me about this whole seasonality thing that is such a big, important part of what you do and knowing exactly when's the right time to buy and sell.
Joe, interestingly, I grew up listening to stock analysis and watching CNBC and Bloomberg and reading the Wall Street Journal. And there's all these analogies. There's always this discussion about, my gosh, you're not going to hold stocks in September and October, are you? Because everyone knows that's always a weak market. The other thought is sell in May and go away. Well, had you sold in May and gone away this year, you'd have left about 35% on the table. So stock seasonality, I really don't see it being very viable. Seasonality, trading, commodities, I think is quite different. You mentioned one, I mean, energy prices. Joe, here's a energy price seasonality 101. During the months of September, October, November, driving season is over in the Western Hemisphere. But yet it's not heating season yet. We're not heating factories. We're not heating homes. We're in shoulder season. We're not high demand. We're right in the middle. And by gosh, if energy prices don't seem to fall every September, October, and November, and it's like, dang, I thought oil was a good buy. Well, it's not a good buy in September. But what you do is you might want to look at buying energy prices in March or April. Why? Because driving season, the largest demand for energy in the United States and Western Europe happens in April, May, and June. And by gosh, if the prices don't start going up, then seasonality trading in commodity is very alive and well, in my opinion.
Oh, yeah, that's fun. Yeah, I mean, you could talk about, as you know, you could probably break down all these because we talked about the coffee growing season, like when it's time for that. We talk about fuel, we talk about grain. Seasonality is so important, and it is one of those things that I don't know if, for lack of a better word, it kind of makes commodities trading fun because you can kind of see, it's almost like you're playing the game, like, oh, it's that time of year to sell, right, James?
I can't tell you how many calendars we have in our office. In January, you trade this market. February, you look for this.
Yeah.
March, you look for that. Coffee prices are often quite high going into the fall season, waiting for precipitation to happen in the largest growers in the world. And everyone gets scared. Oh my gosh, it's dry in October in Brazil. It's always dry in October in Brazil. And then in late October, November, it starts raining. Oh my gosh, we're going to have the largest crop ever. And the seasonality is then prices start falling. So it's seasonalities and commodities is all around.
Yeah. And you talk about the importance of option strike price selection when selling options for portfolio. First of all, break that down because it is about a mouthful. I can barely say it, but option strike price selection.
Strike prices are the level that a buyer and a seller come together and determine what price the buyer is going to be long at if the market rises, or what price the seller is going to be short at. For example, this year we traded a lot of crude oil. As we have a new administration and he is hoping for lower energy prices, we thought energy would stay low in 2025. We didn't think it was going to go to 110 or 120 or 130. The writing was on the wall. The current administration talked, over and over and over about keeping prices low, getting gasoline prices inexpensive. And by gosh, if he didn't visit Saudi Arabia several times this past year, and something tells me that he walked out with a couple deals there, an analysis on strike price selection. If crude oil is worth about $60 or $65 a barrel, which is where it's been trading at for practically the entire year, the likelihood of crude oil hitting $120 a barrel this year were not very good. And that is the type of strike price selection that we would have been doing here in 2025. You're stopping, Joe, buying options where you think the market's going to go, and you're selling options where you think there's no chance in heck that it's going to go. And selling crude oil calls this year at 120, that was a pretty good bet. And that is a form of strike price option selection.
Thank you. Thank you for explaining that. And so we're recording this in early fall of 2025 and really seeing it around that time. Are there particular commodities right now where you're seeing unusually attractive premium opportunities? Fall 2025. I know whoever may be watching this or listening to this, but this fall of 2025, any hot takes from James Cordier?
Joe, the hot take right now is commodities booming. We have interest rates coming down in the United States. We had our first cut this past month. We're expected to have a couple more cuts later this year. That will likely weigh on the value of the U.S. dollar, and people just pour into commodities when that happens. Gold over the last 12 months is up like 85%. So commodities like that, when you start seeing commodities hit the Wall Street Journal, and it's on the front page, or at least the front page of Money and Investing, that's usually a good one to look at, because as excitement about a certain commodity making all-time highs, people get interested in then getting into that commodity. So they've been out of raw assets all year. They've been riding the stock market up and down. But as Wall Street Journal articles start hitting and this market is making all-time highs, investors will then delve into that market. And what they do often is they will buy options. They will buy options on gold. They'll buy options on copper or silver. And that's what gets them very attractively overvalued. In our opinion, selling structured options right now on the precious metals going into the end of this year looks extremely attractive because they are so overpriced and they are so popular right now. To read the Wall Street Journal, you would find that practically every investor knows about the price of precious metals right now because it's so well advertised. When that happens, premiums on call options in some of these commodities get so overpriced. It is certainly a golden age to be selling options when this happens, and when the private sector is getting involved with these, and you're out to dinner, you're out to have a cocktail or something like this, and you overhear people talking about the price of gold behind you, that's usually a good sign. It might be time to sell call options in that market.
So eavesdropping is good for a commodities seller. Just keep those ears open.
Eavesdropping is great for an option seller.
and none of this is buying or selling advice. Obviously, we want people to do their own research. But one of the things I know about you, James, and anyone who either reads your books, follows you online, you're a data guy. You love data, and obviously without data, the commodity, you would not do very well in the commodities industry. So when you look at raw data such as crop forecasts, oil production, or orange demand, how do these big picture shifts shape the opportunities you target for your spreads? Because it all starts with the data.
It does, Joe. Commodity values are extremely clearly priced using supply and demand. If you can compare it to stocks like, for example, phone makers. I don't know, there's about 3 or 4 people or companies that manufacture phones. These 2 companies sold the most phones. The company you picked did not. Um, Phone price companies go up in value, and son of a gun if I didn't buy the wrong one. Commodities are standardized raw products. If you understand all the fundamentals there are about the price and value of cocoa, you're going to do extremely well. You don't have to figure out which type of cocoa. It's standardized. It's just like that. The price of silver and the value of silver, it's silver bars. Silver will never go bankrupt. The price of wheat, you're not going to have the CEO leave the company like what happened, interestingly, in a lot of precious metal companies today as we're taping. It's really interesting that if you simply do your homework, you can learn all you need to know about a handful of commodities. And if you're willing to put in that time, you're able to sell options and option structures, preferably some 50, 60% out of the money. And that is how a new investor that's delving into commodity option selling for the first time can surprisingly start and create alpha for themselves.
Is that what hinders most people, James, is the work? Because I mean, that the W word for a lot of folks is, especially when you're dealing with high net worth people, like, yeah, no, I don't feel like doing work in this. It's like stocks. Oh, stocks. I know. I've heard of Google. I've heard of Apple. Is that part of it? And what separates the sort of like the also rans and the people that are great at commodities? It's the folks that are willing to put in the work.
Joe, my colleague and I, years ago, wrote the complete guide to option selling. It came out in 3 different editions, and it's in 8 different countries and 4 different languages. And what we tried to do is teach the at-home investor how to do this. Primarily, the very, very high net worth investor is unlikely to want to do all of that work and all of that research because they've reached a pinnacle in life that's no longer what they're doing. But what we do offer advice to people that are high net worth investors is to learn enough about it to be able to make an intelligent decision whether this is something that would be suitable for their portfolio. Either do the work or find someone who has done it, and the vehicle of structured leverage option selling on commodities, I think a lot of people are going to find out can be very lucrative.
Sounds good. All right, let's wrap it up with some advice, James. What's one piece of advice you would give an investor looking for, to diversify, like we talk about, into a defined risk option selling for the first time? Like today, they this popped up on their YouTube algorithm or the podcast popped on, like, sounds pretty interesting. I like this. I like having to, do a little work, get my hands dirty, eavesdrop people at restaurants. This all sounds like a lot of fun to me. What's the one piece of advice you'd give them?
A lot of people that are just getting into leveraged option selling now, even after the records that are being hit with option volume, you can't believe that people are still discovering it, but they are. My one piece of advice would be to, if you're a stock option seller and you've been selling options 3 and 4% out of the money, look at possibly diversifying into commodities, corn, wheat, soybeans, coffee, cocoa, sugar. If you want to do just a little bit of work and understand strike price selection, how far out of the money you can sell, the premium that you can receive for actually very little cost in order to do that, I would delve into it and take a look at it. We wrote a couple books on option selling. There are several out on the market. I would look into doing that. And whether you take your portfolio and, put 5 or 10% of this, of your portfolio into something like this or more, you're learning an investment that you had no idea existed. And I think that's going to be something that, can be very valuable to you, perhaps right now or perhaps later on in the future.
What's funny about some stocks, James, or even like in industries where you're like, someone will say, it's too late. Like, it's too late to buy Google now. It's too freaking expensive. It's too late to buy. Well, commodities, there's no such thing as being too late, right?
They're not going anywhere. It's interesting, Joe. The I mentioned a couple of commodities that are like reaching all-time highs. And at the exact same time, we're looking at the prices of sugar or wheat or corn. They're sitting at 52-week lows. It's the perfect diversification tool within these 12 commodities. Some of them are skyrocketing, some of them are going sideways, others are falling. That's ideal for diversifying your portfolio, in my opinion.
Awesome. And if you want to find out more information about James, you can go to optionspreaders.com. James, I will see you next time on Why Commodities.
Great, Joe. Always a pleasure.